You can't be a good investor if your emotions dominate you, because then you'll make the same mistakes as everybody else in the market. You'll buy too much when things get too exciting and prices are too high, and you'll get depressed and sell when things are too low and everybody else is selling. So, control over one's emotions is one of the most important things in the short run. I don't believe that the next 10 years will be characterized by declining interest rates or ultra low interest rates. And that's a major change in the environment. And the things that worked the best in a period of declining and ultra low rates will not necessarily be the things that work best in a period of stable and generally higher rates. And people have to accept that.
I've been interviewing Howard for 21 years before you were all born, obviously.
All the same questions.
All the same questions. Today will be different, though, because if you don't research for Howard, you're in serious trouble, because he will challenge me. Most of it was on Bloomberg TV. We've done a few conferences. But I won't waste time, because you want to hear about from him, not me. I think in the audience today, particularly DeepSeek is front of center, as is interest rates, because the Fed meets today and, of course, announces tomorrow with no change expected. I think it's 4.5%. Nevertheless, tariffs and inflation is an uncertainty for the Fed guidance. But I want to just start, Howard, go straight into it if I can. Let's just talk about DeepSeek. Let's talk about NVIDIA, the darling of the tech stocks, has been rattled. I think Monday it fell by 16%. It may have bounced back, will bounce back this morning, but nevertheless, this Chinese chatbot, cheaper version, if you like, has certainly rattled. It's on Bloomberg this morning, headlines, FT. What is the Howard Marks take on the tech space now that DeepSeek has arrived?
Well, I don't have a take on the tech space. I don't know anything about tech, and we practically don't do anything with stocks for the most part. But I think is a really important lesson to be learned from the action yesterday. And, I was busy yesterday, and I came down here and took a look at my phone, and it talked about NVIDIA being down $600 billion in value at the time. But the interesting thing to me was that everything else was down big. And, unsurprisingly, perhaps to you, I keep the stock prices of the companies in our industry on my phone, and they were all down big, including Brookfield, which we're allied with. And that's the interesting part. And markets all around the world have reflected this action. Why? Development with regard to DeepSeek, which put NVIDIA down so much, was very specific. Competitive threat to their activity. And as the Brits would say, full stop, right? So why would anything else go down in sympathy? Why the investment manager stocks? And so what's the connection? What's the common thread? And the answer is psychology. And, psychology is by far the dominant influence on investing in the short run. It has very little to do in the short run with fundamentals. How did yesterday's developments fundamentally affect all these other companies and industries and countries? And the answer is they didn't. The common thread is psychology. And, I put out a memo earlier this month on the subject of bubbles, because January 2nd was the 25th anniversary of the first memo I ever wrote that got any response, called bubble.com, about what was going on in the tech space 25 years ago. And I said in the memo, this memo, that a bubble is not a period of rising prices, it's a period of temporary insanity. And if it were just objective, clinical, unemotional investors looking at NVIDIA, there would be no reason why yesterday's news should knock all these other things down. But it just shows you the pervasiveness of psychology and the irrationality of the markets in the short run.
But is it also valuations are very stretched? I mean, temporary insanity.
Well, that's what, yes, well, it's temporary insanity that leads to stretched valuations. But to me, the important thing is not the stretched valuations, it's how they got there. And it's through this loss of objectivity, which then you have to say to yourself, well, how is that affecting every other part of the market, including the parts I care about?
Is that therefore the herd mentality that everyone follows NVIDIA, even though shares are rising and rallying, in fact? Well, you've got to be in it or you lose out.
Well, that's what happens.
Like .com.
That's what happens in a bubble. People say, basically, everything swings towards optimism and greed and risk tolerance, but basically, you know, we're supposed to be afraid of losing money, our own and our clients, but in a bubble, the bubbles go where they go because FOMO takes over from the fear of losing money. And people become petrified that somebody else will be in something and they won't be in it, and they'll have to kick themselves, or they'll lose out competitively. You know, Kindleberger, in the book Bubbles, Manias, Panics, Manias, and Crashes, said there is nothing so injurious to your mental well-being as to watch a friend get rich. And that statement typifies the sentiment that takes over in a bubble.
But for those in the audience who are waking up this morning extremely nervous, highly exposed, what's your advice at this current moment? How do you deal with the situation?
Well, first of all, you know,
with your approach to it, not
first of all, I mean, yesterday's
kind of
what happened yesterday, the reality affected NVIDIA, AI, tech. The impact, the carry-on impact into other sectors should go away, you would think, because it had no fundamental import, except that it connoted elevated psychology. And so everybody should look at their holdings and try to make sure that the things they own based on strong and improving fundamentals, and not just, they don't hold them just because they think they're going up. Now, of course, nobody in this room would ever hold anything just because they think it's going up. They would have to have reasons. But I think it's time to double check.
Hey everyone! Just wanted to quickly say I hope you are enjoying this video, and thank you for supporting the channel. To show my appreciation, I compiled 17 years worth of Howard Marks's legendary investment memos that you can download for completely free at the link in the description of this video. Make sure to get your copy because legendary investor Warren Buffett has said that Marks's memos are the first thing he reads whenever he gets a copy in the mail. Let's get back to the video.
Let's talk about market dislocation.
Yes.
And navigating market uncertainty. I won't go into politics on this because there's uncertainty about what's going to happen regarding tariffs. Obviously, that's going to weigh on the Fed guidance tomorrow. Guidance is probably more important than the actual rate decision. I think we all agree on that. But I mean, how do you navigate? I mean, the question really is, how should investors position themselves for the coming months? I'm not asking you to forecast. I know you don't like that question. I wouldn't do that. But how do you position yourselves now in the alts and the alternative classes?
Well, I think that one of the characteristics of alternative investments is everybody makes these investments because they're supposedly alpha investments. They're supposed to be investments where the return will be primarily a function of the skill and judgments made by the managers of the investments. And that's as opposed to beta investments where most of the return is a function of what goes on in the market. So I think, you know, we should be, the alternative managers and their investors should be relatively isolated from so-called market developments. And what
should be, though.
Yeah,
what
right.
If not?
Well, there should be, but sometimes psychology takes over and becomes this overarching trend. Not supposed to be the case. But I think, you know, we should be able to isolate our clients from market developments because they should not be at the heart of our returns. And, you know, what I say at Oaktree is that we try to find companies, we try to invest in companies that will grow and companies that will repay the money we lend them. That's the important thing, not what the Fed does or what the market does or what the administration does or something like that. So, you know, one of the features of alternative investing should be that we diversify our clients from market developments. But of course, we have to constantly make sure that we've made our investment decisions for good fundamental reasons.
Do you feel a wall of uncertainty coming at you from your 35 years, or is it longer of being in the markets?
Oh, 55.
55
years. Kind.
Howard is, I shouldn't say this, but I will say this if you don't mind. Howard is 80 next year. He's actually 78 now, but he's 79 in April, and he's still flying around the world. He has an incredible energy. Also, survived cancer 2 years ago, and he's just standing strong. So he's just an extraordinary power. So it's a question of how do you push through this?
Well,
not you personally, but just generally.
Yeah, I mean, you know, you can't be a good investor if your emotions dominate you, because then you'll make the same mistakes as everybody else in the market. You'll buy too much when things get too exciting and prices are too high, and you'll get depressed and sell when things are too low and everybody else is selling. So, control over one's emotions is one of the most important things in the short run. You asked about uncertainty. I think that uncertainty, and what do you do about developments in the political arena today? Uncertainty is the word of the day. In normal circumstances, you try to figure out what you think will happen that's important in the long run in, let's say, the political arena, and you maybe bias your plans a little bit toward that, although, again, what should matter is the specifics of your companies and industries and not what goes on in the so-called big picture. But you have to admit today that we know less than usual about what the future holds in that regard. And this administration is less predictable than most.
That's the problem, isn't it? It's unpredictable and uncertain. There's two feelings to it.
Yeah. Well, I don't know if the members of the administration could predict what they're going to do a year from now. I certainly know I can't. I don't think you could enunciate a common thread that runs through these activities other than dislike of the establishment. But exactly how it's going to manifest itself, we don't know. And we want tax cuts and smaller deficits, and we want to discourage imports and control inflation. And there are many ways in which the individual manifestations of the attitude are in conflict with each other. It's hard to find the common logic. So most people, you have a very strong view of what they stand for and what they're going to do in consequence. And I think today we have to just watch to see how this administration's predilections determine its actions.
I will go into in detail asset classes after this question.
Hopefully not.
Hopefully not. Interest rates, we must tackle that.
Yeah.
It's really about the guidance tomorrow when the Fed announces 4.5%. But I think the question for the audience really is, how do you see, you talked about, in fact, right, sea change in rates back in 2022, your memo, 2029, 2021 was that period you talked about the sea change in rates. How does the rate environment affect asset prices, Howard?
Well,
how do they position?
Now you're talking, because interest rates constitute our environment, just like water is to fish, and they determine whether the rate of economic activity, and they determine the value of assets, because, among other things, the value of an asset is the discounted present value of the future cash flows, and when you decrease the interest rate, you increase the discounted present value. So it's a direct relationship. However, I will take issue when you say it's all about the Fed guidance tomorrow, because I try to dissuade people from caring too much about short-term events. And I wrote a memo in November of 22, which got relatively little attention, called What Really Matters. And I talked in there about 5 things that don't matter, in my opinion. Short-term events, short-term performance, short-term trading, hyperactivity, and volatility should not matter to a long-term fundamental investor. And I mentioned in there that in 2017, for example, the only question I ever got was, what month is the Fed going to start raising interest rates? And I would say, well, why do you care? If I tell you March, what will you do? And if I tell you, oh, no, it's not March, it's May, what will you do different? And people ask about these things, in my opinion, have no importance. The day an interest rate action is announced, it may influence prices that day and maybe the next day, but it doesn't influence the course of events. That will determine based on long-term policy and on the larger economic environment that materializes. So I don't care about the guidance. I made the case in late 22, which I called the sea change, that in 1980, I had a loan outstanding from a bank personally, and I got a slip in the mail that said the rate on your loan is now 22.25. And 40 years later, in 2020, I was able to borrow at 2.25. And so rates came down by 2,000 basis points over 40 years. And anybody who came into this business since 1980, which I imagine includes most of you, have only seen declining interest rates or ultra-low interest rates or both. And I don't believe that the next 10 years will be characterized by declining interest rates or ultra low interest rates. And that's a major change in the environment. And the declining interest rates over that period and the ultra low interest rates were like a moving walkway at the airport. And you get on the walkway and you walk at your normal speed and you make great progress over the ground and you say, boy, I'm fit. But it's not you, And in the same way, people made certain decisions and companies made a lot of money over the period you mentioned, 09 to 21, which was really the easy time because the Fed funds rate was zero most of the time and averaged 0.5%. And the people who made those decisions say, boy, I'm a decision maker. But it was the rates. And if Einstein said that the definition of insanity is doing something over and over and expecting a different result. I think another version of insanity is doing the same thing in an entirely different environment and expecting the same result. So the things that worked the best in a period of declining and ultra low rates will not necessarily be the things that work best in a period of stable and generally higher rates. And people have to accept that. And so I look at the Fed to try to figure out which it's going to be. And I have my conclusion.
Do you have confidence in Jerome Powell?
I do, yeah. I haven't taken issue with the...
Are you relieved that he's staying as Fed chair? When you heard
Yeah, I would not take out any multi-year subscriptions at this point, but I'm relieved that I believe he'll be there until May of 26, and I think that's a great thing for the country.
When we were talking about what to discuss, Howard said, please can you point out my memo from October? For those who read the memos, I'm sure you all do, ruminating on asset allocation.
Yeah.
The only asset classes are ownership and debt.
Yeah.
They differ enormously in terms of their fundamental nature. And to me, ownership is stocks and debt is fixed income or bonds. But I want to kind of just, because you've got time is always against us, Howard. But I want to ask, in the capacity for this audience, in alternative, you are probably the largest global investment of alternative classes, 200 million, I believe.
Yeah.
200 billion, excuse me, AUM.
Right.
And the roots are in private credit.
Yes.
So it's distressed debt and private credit. Here, real estate, even crypto, they're all alternatives. So with that memo in mind, ownership, debt, can you just, I won't talk anymore, just talk about the alternatives that excite you and that you're nervous about?
Well, if you take what I call ownership assets, which are stocks, companies, properties, for the most part, their probability distribution governing their future returns or future developments looks something like this, your standard bell-shaped curve. And historically, of course, for the last 100 years, the S&P has averaged 10% return, so quite good. But sometimes 20 and sometimes 0 for maybe a decade. 0 in the decade of the aughts and 20 in the decade of the 90s. Then you look at lending strategies, fixed income strategies, and the distribution of returns looks like this. It's very tall and very narrow. There's very little uncertainty with regard to what the long-term return on an 8% bond is going to be. There's no upside. You're not going to make 10. Here's a shocker. But you're also likely, if you put together a portfolio of 8% bonds, you're probably not going to make less than 7. So very little uncertainty, but a lower expected return because it's more reliable. Ownership assets have a wider range of possible outcomes, but a higher expected return because you're asked to shoulder uncertainty. So what I said at the better, which is better? And in a market which is intelligent or efficient, there is no better or worse. It's only your personal choice and your predilections and the application to your situation. So, and by the way, it's not all one or all the other, you mix them. So you get a progression of curves that the more uncertainty you shoulder, you normally expect a higher expected return, but with increased uncertainty. But you look today, and the things that we do are typified by high-yield bonds, for example. And I was really lucky because I was asked to start Citibank's high-yield bond activities in 1978 when that business started. So today, high-yield bonds offer 7.3%, which is a pretty good return in the absolute and, more than most institutions need. But then you look at the S&P, which historically has returned 10 for the last century, and Goldman Sachs came out at the beginning of November and said over the next decade, stocks will make 3. And JP Morgan published a table at the very end of the year which showed that if you bought the S&P at today's PE ratio, any time between 88 and 2014, you made between -2% and 2%. So slightly different, but same zip code, low single-digit returns. So if you can get low single-digit returns from the S&P with great uncertainty, and 7.3 from high-yield bonds contractually, isn't it better? That's all. And the Wall Street Journal had a story yesterday. The first sentence said that by one measure, stocks offer the lowest equity risk premium since 2002. And in fact, it was a negative relative to treasuries. So, you can't say, well, stocks are better, stocks are great, stocks have returned 10% a year for 100 years. You have to say, what are they likely to return from where they're priced today? And I think that the outlook for ownership returns is not as good as it usually is relative to the risks entailed.
With that in mind then, because time is against us, I keep saying that, you are a pioneer in distressed debt and in private credit. Mm-hmm. There is a boom in private credit. Can it be sustained? And distressed debt is often, as you always told me, it's catching falling knives, John. Yeah. Often within a crisis situation.
Yeah.
Which of those areas excites you, and which of those would you think, like for example, private credit, there's a boom. People are concerned about it.
Yeah.
Can it be sustained? So
well, look, distressed,
nervous?
Not nervous. The only thing that ever makes me nervous is that we won't have great things to buy. I'm never worried that there are going to be negative developments in the macro environment. That's what we make our money for, especially if we can approach them unemotionally.
Because you have an appetite for risk.
Right.
A strong appetite
yeah.
for risk.
But, everything has been so placid. With the momentary exception of the pandemic in 2020, everything has been so placid in the investment environment from, let's say, 2010 to date, really, that, there hasn't been much distress, and there hasn't been much for the bargain hunter or the opportunist to do in the last 15 years. I do believe that in the period of ultra-low interest rates, a lot of companies were saddled with capital structures that they will not be able to sustain given rates 400 or 500 basis points higher, which I think will prevail, and where credit is not quite as easy to get. And when those debts start coming due, mostly in 26 and 27, some percentage of them will not be easily rolled over, and then we'll have more to do. So I'm excited about that. And we've raised a big fund to do it, which is only half invested. But, you talk about private credit, it's such a broad thing. And I think, the question we get is whether that is the next systemic risk area. I don't think so, because I don't think there's the interconnectedness and the high level of leverage that we saw, for example, in the banks during the global financial crisis. But I think what you have to think about is whether the managers who benefited from the onrush of capital into this sector wisely were patient, applied high standards, and demanded good quality underlying assets during this gold rush.
How do you view, two more questions, how do you view crypto? 109,000
I don't
off
know
that
anything
now.
about it. My son Andrew has convinced me not to say anything about it.
Okay. But
he says, Dad, it's not a good idea to talk about things you don't know anything about.
You talk about
only your son can say that to you, of course.
You talk about temporary mania. Would that fall into that? Okay.
Who knows? We'll see.
Warren Buffett, it was back in 2018, likened it to rat poison squared and predicted a bad end.
You know what? Andrew lived with us during the pandemic, and he bought it at 4,000, and today it's 102,000. So it's hard for me to tell him he's wrong.
Okay. That's a good line. Final question for you. Are you going to slow down at all?
Why?
Right, that's a good answer.
I'll slow down when you slow down.
Okay, I'm not going to slow down.
I mean, what would I do?
What would you do?
Well, I'm not a golfer, and I don't, it's stimulating what I do, and I'm blessed with good genes, and I can keep going, so why wouldn't I?
You're traveling relentlessly.
Yeah, why wouldn't
You flew in last night, you're flying out.
You know what? Bill Graham, who ran a club called the Fillmore, which was a rock club in San Francisco in the 60s, once said, it's only work if you'd rather be doing something else.
On that note, thank you very much.
Thank you all.
I hope you found this video both entertaining and informative. If you're interested in learning more about Howard Marks, Make sure to download this completely free investing guide at the second link in the description of this video. Marks has become a billionaire by mastering the art of avoiding losing money. The ultimate Howard Marks risk management guide shows exactly how you can follow Marks' investment strategy to help reduce risk when investing. Make sure to check it out because it is my free gift to you for supporting the channel. Also, if you enjoyed this video, check out Howard Marks' 78 years of investing wisdom in 60 minutes here. Because with over 1.2 million views, this video is having a huge impact on people. I'll see you over there.